Let's bring in our next guest. That's going to be Al Lord, founder, CEO of Lexard Capital Management. Welcome to the show, Al.
Great. Hey, great to be with you, Tom.
So I think this is a pertinent topic to be talking about, Al. Basically commercial property, right? Real estate. I think that's the warning sign that a lot of people have put on the market in 2024 is commercial real estate. And you've heard a lot of downgrades in this area. What's your outlook here for 2024?
Well, the commercial real estate motto is stay alive to 25.
Okay.
The overall expectations are 2024 is going to be a difficult year. We have $1.5 trillion debt of commercial mortgages coming due over the next 2 years. And we had record high distress, certainly in the last 10 years, of $80 billion in the third quarter, and the fourth quarter numbers will come in with slightly higher distress levels. So it's bad, and it's going to get worse before ultimately things should get better in a year or so.
When you look at this, distress, I saw some of your notes, delinquency rates going up a little bit. Do you expect that to continue? And what gives you, staying alive till 25, what gives you that optimism heading into past 2024 that it may improve?
Well, certainly the Fed lowering rates is a big part of that. The other piece of this has been higher operating costs, and inflation has hurt us all. Inflation was especially difficult in the real estate world, especially with insurance rates. And then when you look at floating rate mortgages, obviously these Fed increases have had a big impact on mortgage payments. And then you've also had big increases in property taxes. So while rent growth was modest in 2023, operating expenses were much higher. That will all level out. Inflation is coming down, and the Fed will start lowering rates. The question is by how much. But that will certainly help things, and it'll help refinancings. All this debt that's going to mature is going to have to get refinanced at much higher rates. All of it won't get refinanced, though, because of lower values, especially in the office sector. The office sector has just hit the highest vacancy rate of all time. Almost 20% of nationwide office space is vacant. That's a trouble. That's an issue that's got to get worked out through the year.
You bring up a good point, Al. I'm in Chicago. I see a lot of for lease signs. I see people, companies just kind of walking away from their leases in some of these buildings. I've seen REITs do it out west in San Francisco and some of the other big cities. But when you look at this, things are changing, right? Globally, the remote work, maybe you don't need as much office space. Now you're starting to see companies starting to tighten their belt even more. You said that vacancy rates are at record levels. Does that peak out eventually, or do you see it maybe topping out where it is now?
Yes, it will peak out, and ultimately we have supply demand issues, and the office space just has too many office buildings. But what's happened over the course of the last year and a half, as the Fed started raising rates and as the economic picture looked bleaker, and there's a lot of concern of recession and weaker growth, and that's played out in terms of weaker growth. And so that's diminished supply that's now getting permitted and construction starts. So new construction is down across the board, right, in all types of real estate, given what's happened with financing costs and given the outlook on the economy. So ultimately the supply demand imbalance will come better into balance. And so yes, things ultimately will get better. But there's going to be some more pain this year.
Yeah, market's pricing in 150 basis points of cuts this year. Fed said only 75. I think the real estate market wants 150. Switch over real quick here to Al to the residential side. We've seen mortgage apps kind of gyrate a little bit. We're off of those high 10-year yield levels from over 5%, now back below 4%. That's a bonus. It seems like the demand side of it continues to be there. Supply's not there. How do you look at the residential market at this point?
Well, residential prices were up 4% year over year. Mm-hmm. Despite a market that didn't have a lot of activity, prices were still up, and despite mortgage prices. And so, we saw mortgage rates hit over 8% last quarter. That has a big effect on demand. And yeah, ultimately, there's just been a much slower market. There's been fewer buyers, fewer sellers. There's just a lack of inventory. And given where rates are, buyers and sellers both think this is the wrong time to enter the market. So if you have both sides of the equation thinking things will get better down the road and not now, then it leads to little activity. And so ultimately, there is a shortage of houses. There's a shortage of newly built homes. There's a shortage of existing homes,
Yep.
and there's a shortage of apartments. And so the supply demand will go even further out of whack. But in the short term, just given where we are with the with a slowdown and economic growth, there's very little activity happening right now.
Yep. Yeah, supply issues, demand is still there. There's a queue built up. They need those rates down. All right, great breakdown here for us, Al. Have a great weekend.
Right, you too.
All right, that's Al Lord, Lexard Capital Management.